to another one of our online updates, so to speak. And the reason why we're bringing you a tax update long before your next tax letter for tax is due to start is because on the 22nd of February 2012, we saw Minister Praveen Gordhan giving us this year's budget speech. Now you'll see from your UNISA material and the information set out for you, particularly in tax letter 103, UNISA did indicate to us that SACA and UNISA are wanting to examine taxpayers on the 2013 year of assessment. Now this was a little bit difficult because a lot of the information we have only related to the 2012 year. So what we saw on the 22nd of February was the Minister of Finance do one or two things. So the first thing he did for us was give us, for the 2013 year of assessment, the new tax tables. So those will be the tax tables that an individual will use. Once the individual has calculated their taxable income, they will plug that taxable income into the tax tables and work out their tax liability for the 2013 year of assessment. Now those tables will be uploaded onto our NSOA Student Zone and you will be able to get the new 2013 information. Now remember, not only do our tax tables for individuals change every year, but we will see that in his budget speech, Minister Praveen Gordhan also announced to us the new rebates that will apply for the 2013 year of assessment. Remember, for individuals, the 2013 year of assessment will start on the 1st of March and will run through to the 28th of February 2013 next year. So we've got to also be aware that when we're calculating an individual's taxable liability for the year, once we've plugged their taxable income into our new 2013 tax tables, we will then have to take off from that tax liability the 2013 rebates. Now remember, we will also be uploading those 2013 rebates onto the NSOA Student Zone for you. But once you've calculated the tax liability in terms of the tax tables, you must then go on to have a look at your taxpayer's age, because if they are a taxpayer under 65, they will enjoy a primary rebate. If you are over 65, a primary and secondary rebate. And if you're a taxpayer over 75, you get the primary, the secondary, and the tertiary rebate. So all of those rebates have been increased very slightly for 2013. And as I said, we will be setting those out for you on the NSOA Student Zone. So please be careful of having to apply these new rates. Now the next bit of information is going to refer to the information contained in your touch letters 104, both for CTA level 1 and CTA level 2. And that is the information that we saw given to us for capital gains tax. Now, very unexpectedly, we saw announced to us on the 22nd of February 2012 increases in certain of the rates of capital gains taxes. So let's have a look at those increases, but let me make one thing clear first. The new rates that were introduced to us last week in the budget speech, these new rates will be effective right now from the 1st of March 2012. Now this is going to leave you guys in a slightly strange situation because remember, when UNISA and your textbook like Silk, for example, drafted the information that you're going to need for this coming tax year, they did not know that at the very 11th hour in this year's budget speech, those rates for CGT were going to be changed. So the information reflected in your type letters and in your textbooks is effectively now out of date. So when you look at solutions around CGT, when you look at your information in your textbooks around CGT, these rates that I'm going to be telling you about won't be reflected there because we had no idea when all that information was drafted for you that the rates were going to change. So what has happened? Well, remember, for CGT, when we start with our taxpayer needs an asset. They've had a disposal in respect of that asset. For that disposal, they got proceeds or deemed proceeds. And from those proceeds, they've taken off the base cost of the asset. So that taxpayer has now added together their gains and losses from each asset disposed of during the year. Now, what we said then was after we've added the gains and losses together from each asset disposed of, if we looked at that calculation, we would have our aggregate capital gain or loss for the year. Now, if your taxpayer was a natural person taxpayer or a special trust, which isn't a normal trust, if our taxpayer is a natural person taxpayer or a special trust, from their aggregate capital gain or loss for the year, we would then take off their annual exclusion. Now, what's happened is, from the 1st of March 2012, the annual exclusion that a natural taxpayer can enjoy has increased to 30,000 every year of assessment. So we saw that the annual exclusion before we started the 2013 year was 20,000. It then now, as of the 1 March 2012, has gone up to 30,000. Now, if the taxpayer, natural person, has died in the year of assessment that we're looking at, we know that in the year of death, a natural person taxpayer has a deemed disposal of all their assets. And as a result, they are deemed to dispose of their assets for proceeds equal to market value. We take off the base cost, we calculate the gains and losses, and those which are not disregarded or rolled over, we bring into that deceased taxpayer's tax calc in their year of death. Now, because of this increased capital gain that you could have in your year of death, we know that in the year of death, a taxpayer had as an exclusion 200,000, not that 20,000 annual exclusion every year. Now, as of the 1st of March 2012, for the 2013 year of assessment, that annual, well, let's say that death exclusion has gone up to 300,000. So please be careful from your 2013 year of assessment. Each year that the individual natural person taxpayer is alive, they can decrease their aggregate gain or loss by 30,000. As of the 1st of March 2012, the 2013 year of assessment, taxpayers who die in the 2013 year of assessment, they will have that death exclusion. Their aggregate capital gain or loss will be reduced by 300,000, not 200,000. Now remember that once we had calculated the aggregate capital gain or loss, and if it was an individual, taken off their annual exclusion, or in the year of death, their death exclusion, for all taxpayers, we would then take off any capital loss carried forward from a previous year of assessment, and what we would then end up with is a net capital gain or the assessed capital loss from that year of assessment. Now remember, taxpayers who had an assessed capital loss for the year of assessment, that assessed capital loss cannot do anything except be carried forward to the following year of assessment. But what we did realize was that if we had a net capital gain, in order to turn that net capital gain into a taxable capital gain and include that taxable capital gain into our taxable income, we had to multiply that net capital gain by what was known as the inclusion rate. Now remember, we know that if we were looking at an individual, that inclusion rate was 25%. Now, as of the 1st of March 2012, right now, that inclusion rate has been increased to 33.3%. So any individual taxpayer who's got a net capital gain will take not 25% of that net gain anymore, but for the 2013 year of assessment, will pull 33.3% of that net gain into their taxable income, by that net capital gain becoming a taxable capital gain. Now, if we are a company, what used to happen before was that the company would take 50% of the net capital gain and pull 50% of the net capital gain into the company's taxable income by making that net capital gain a taxable capital gain. Now, for companies, that rate has also changed from the 1st of March 2012, such that 66.6% of the net capital gain will be pulled in as a taxable capital gain into the company's taxable income. So what we've seen is, for individual taxpayers, that inclusion rate increasing from 25% to 33.3%, and for a company, the inclusion rate increasing from 50% to 66.6%. Now, our last taxpayer that we have to think about is our trusts. Now, our trust also used to have as an inclusion rate 50%, but for a trust, that inclusion rate has increased the same as a company from the 1st of March 2012. So the trust also has an increased inclusion rate of 66.6%. Now remember, what we said is that if we look at these inclusion rates that are applied to a net capital gain to make that net capital gain a taxable capital gain, those taxable capital gains were then included in taxable income of the taxpayer. So therefore, once the taxable capital gain was included for an individual, that individual would then pay their normal tax rate on that taxable capital gain in their taxable income. So if we're assuming an individual with a top marginal tax rate of 40%, we used to say that if we took the inclusion rate multiplied by a natural person's rate of tax, that gave a natural person an effective CGT rate of 10%. Well, remember, we have to adjust that now, because as of the 1st of March 2012, if we take the new inclusion rate and assuming our individuals in the top tax bracket, what we're seeing is the effective rate of CGT for an individual has increased to 13.3%. Now, how does that play out when we're looking at a company or a trust? Well, we simply apply the same thought process, because we've said that for a company, they now have to take 66.6% of the net capital gain and plug that into the company's taxable income. So effectively what we're seeing is a company's effective rate of CGT now sits at an amount of 18.6%. Now, what do we have pre-1 March 2012? Well, we only used to take 50% of the net capital gain, and 50% of that at the company's tax rate of 28% gave the company pre-1 March 2012 an effective rate of CGT of 14%. So we're seeing it's become quite a lot more expensive to make your net capital gain in a company because of this increase in the effective rate of CGT. So what's happened to trusts? Well, remember, for trusts, they are now putting, as of the 1st of March 2012, 66.6% of the net capital gain into the trust's taxable income. A trust pays tax at a flat rate of 40%. So the trust's effective rate of CGT is now 26.7%. Now, this is quite an increase from pre-March 1, 2012, where we took 50% of the trust's net capital gain, multiplied that at the trust's marginal rate, which is a flat rate of 40%, and a trust previously paid CGT at an effective rate of 20%. So what has effectively happened is an individual, their effective rate of CGT we saw increasing. But an individual is a little bit protected because their annual exclusion was also increased from the 1st of March 2012 from 20,000 to 30,000. We see, however, for a company or a trust who cannot have access to the annual exclusion, they have simply become a lot more expensive as vehicles to hold capital assets in because of this increase in the effective rate of CGT. By the increase in the inclusion rate, that percentage of the net capital gain that we pull into the company and the trust's taxable income. Now, what other CGT news did we see applying immediately from the 1st of March 2012 that was announced to us in the budget speech on the 22nd of Feb? Well, we know that where a natural person ordinarily resides in a residence that they use mainly for domestic purposes, when that residence is disposed of, because the residence is regarded as a primary residence, a natural person, once they calculated their gain from that disposal, had access to the 1.5 million primary residence exclusion. Now, as of the 1st of March 2012, that primary residence exclusion has been increased to 2 million. So when our natural person now disposes of their primary residence, they are going to take the proceeds from that disposal minus the base cost. The gain that they make or the loss that they make will be decreased by your primary residence exclusion of 2 million now and not 1.5 anymore. So please be careful. This is again of application, as I've said, from the 1st of March 2012. Now you know that we have certain exemptions available to taxpayers, and those exemptions are contained in Section 10. Now Section 10I was and is our interest exemption. And remember, from the 2012 year of assessment already, the 10(1)I interest exemption is of application only to local South African sourced interest. And what 10(1)I for 2012 said to us was that if we were looking at taxpayers who were under 65, they got an amount of 22,800 of their South African sourced interest tax-free. And if our taxpayer, clearly only individuals, was 65 or over, they got an amount of 33,000 of their South African sourced local interest tax-free a year. Now, what we were waiting to see was how that interest exemption available to natural person taxpayers on South African sourced interest would be increased for the 2013 year of assessment. Now, it was not increased at all in this year's budget speech. So for the 2013 year of assessment, the rate, the amount of interest that a natural person can get tax-free per year when that interest is from a South African source is going to remain at 22,800 and 33,000 depending on our individual's age. So please be aware, we are very used to every year seeing this interest exemption being slightly increased. It was not increased in this year's budget speech, so that is one thing that will stay the same. Now, what we saw in this year's budget speech was that there was a very, very big focus on individual taxpayers and high net worth individuals. So that's why we saw a number of your more passive investment type incomes coming under scrutiny, the interest exemption not being increased. If you've invested in capital assets and dispose of those capital assets, your rate, effective rate of CGT has gone up for all the taxpayers. Now, one thing we're going to be dealing with, and we'll be dealing with it when we get to Tight Letter 106, is the new dividend tax that is going to be implemented from the 1st of April 2012. Now, we've spoken a lot about the new dividend tax and how it's going to replace STC. STC was levied on a company at a rate of 10%, and we had heard that the new dividend tax, although it was going to be a tax on the shareholder of the company, not the company itself, that was going to be implemented at the same rate as STC, 10%. Well, just as a little bit of a heads up, because it's going to be April fairly soon as well, we were announced, or it was announced to us in the budget speech, that the new dividend tax, in fact, will not be implemented at 10%, but it's going to come in at 15%. So therefore, what do we see now? Taxpayers who are earning income in the form of local dividends, they've made an investment in shares and they're getting local dividends. Those dividends are going to be taxed not at 10%, but at 15% now. And we're seeing, as I've said to you, any capital gains that have to be taxed are going to be taxed at that slightly higher effective rate of CGT. Also, if you are putting money in the bank, making interest-bearing investments, your interest exemption has stayed the same. So therefore, you're not getting any extra tax benefit. So what our budget did for us this week was really focus on our individual taxpayers that are earning this passive investment income, and as I've said, are now going to be taxed more on that investment income. So please remember, look to see the date of your transactions. Look to see which year of assessment you're in, 2012, which finished now on the 29th of February 2012, or are you in the 2013 year of assessment starting on the 1st of March 2012 for most taxpayers? Be careful that a lot of the examples set out for you now in your textbooks like Silk, in your UNISA suggested solutions, they might not have the correct numbers in them simply because this was an unexpected change. So let's have a look. Keep an eye on your My UNISA area or notifications as well, because I'm very sure UNISA will be putting out some information. And also be sure to keep an eye on the NSOA website, Student Zone, because we will be putting your new tax tables, new rates, etc. on this website. The last thing I want to draw your attention to, and this is in respect particularly of our deluxe students. Students have just written test 1 for tax. I've marked a lot of those scripts myself. I'm seeing that you guys are not taking to heart the information we're giving you about the areas that you need to focus on. So a common example was for VAT. We told you how deemed supplies, those fringe benefits, company cars, insurance payments were a big area of focus. Notional input VAT on fixed property, how that changed as of last year's promulgation of the Taxation Laws Amendments Act on the 28th of December 2011. These issues were brought to your attention again and again, both in our online snippets, our online updates, and in your tutorial DVDs. And yet in the test questions and the marking that I did, it became clear to me in the answers you guys are giving that you're not following the information and the areas that we're telling you to focus on. So please, we are here to help. Take the information, take the guidance the lecturers are giving you, and use it to assist you in your studies. So good luck for the rest of your tight letters. Good luck in keeping up. For you guys who are falling behind, be careful. It's very, very early in the year to be falling behind. Let's renew our motivation, renew our enthusiasm that we started with, and keep up with your studies.